Pandemonium, paradise lost, panic, populism, pendulums swinging, Powell speeches, portfolios, passive impacts. What a week we had. And so we are going to talk about a number of different P's this week. And the reason I decided on that is because I couldn't decide what I was going to talk about. There was so much stuff to cover that I figure we'll just throw it all together and try to have some fun. So in any case, pandemonium was the best word I could come up with to summarize the week. And if you're not familiar with the word, it's basically some kind of wild and noisy and disorderly confusion, chaos, however you want to describe it. But it's also, it just so happens that Pandemonium was the name of the capital in John Milton's book, Paradise Lost. And in many ways, people are freaking out and losing their minds and panicking because in some people's view, America is in the process of being lost. And while some people think it's being refound, others think it's being lost. But regardless of which side you come down on, it's crazy right now. And emotions are running super high on both sides. And as a result, we have seen absolute panic in the markets. And we've seen all of the profits that were made over the last 15 months, or mostly in 2024, disappear just like that. We've had the worst week since COVID. And I think it's one of the worst weeks of all time. And I saw an interesting stat. I think the 5 worst days in stock market history, worst individual days, I think are not, I'm not saying this right. I think the 5 or 6 times that the Dow has fallen more than 1,000 points in a day, it has been under Trump. So that, you know, those who are against what Trump is doing are highlighting that statistic. But the thing is, this is more than just markets. It's much more than just markets. The markets are taking the impact of it, but it's about much, much more than markets. And in many ways, it's about populism. Now, populism is what got Trump elected. And love him or hate him, Trump is the one that is impacting the whole world right now. And he is the one, his policies, there's another P word, his policies are what is driving the market reaction. But you have to understand that Trump came in as a populist president, and he got a large number of votes, and he has a mandate. And not only does he have a mandate, but he has the Congress to back him up. Now, things have gotten crazy enough that you're starting to see some of the people in his own party, there's another P word, some of the people in his own party are starting to get cold feet. And they're already starting to say, hold on a minute here. If this continues, we're going to be in trouble come midterms. And I think the other reason people are panicking is I think there's many, many people who just automatically assumed that because Trump is such a visual guy and he likes to be known as the ultimate winner, that the first sign of volatility in the stock market, that he was going to pivot. There's another P word. Just thought of that. And the fact that he has not yet pivoted, I think, is just pissing some people off, for lack of a better way of saying it. And I think there's a lot of people who just assumed that this would not happen, that it was all a big bluff. But one of the things that we've been talking about for a long time, many months, certainly most of this year, was that we didn't think that that Trump was bluffing. We thought that he was very serious, and those who thought he was bluffing were going to get surprised. And so far, that's what we're seeing. Now, I'm not going to sit here and say that Trump won't come out and change his mind. Maybe he will, but I don't see it that way. And part of the reason I don't see it that way is that's the populists who got him elected. And you have to understand the reason populism works. And sometimes populism is viewed very negatively. It's very similar, and it can very quickly spiral down into nationalism. And there's obviously a lot of people who think that that's already where we are at. But regardless of how you title this, the reason Trump got elected was because he ran on a populist platform. But even more important than that, you have to understand the reason it worked is because the populists largely felt like they had been ignored. So in other words, if the previous administrations, maybe even the previous Trump administration, but the Biden administration, the previous Trump administration, the Obama administration, the Bush administration, especially post the global financial crisis, many blue collar or rural citizens or the populace, the flyover states, felt like they had been ignored. And Trump comes along and starts talking to them. Now, many times we've talked on the show, it doesn't matter whether we agree with Trump is doing or not. The bottom line is that he struck a chord with the flyover states. He struck a chord with Joe Sixpack. He struck a chord with Main Street America. And they gave him a mandate to change things. And I think that Trump actually does want to change things. Now, of course, more than anything in the world, Trump wants to go down as the greatest president in history. And he wants a glowing endorsement on the front page of the New York Times. And he wants everybody to say that he is the greatest. But you can't become the greatest without making some big moves. And the thing is, the guy just doesn't care what anybody else thinks. And so he is going to try to make moves. And when we talk about financial markets, we always try to remove our own opinion from whether something should be done or not, and just look and see what the outcome is going to be, whether we like it or not. And I think that Trump and his team honestly believe that if they don't make a change and rewire the US economy, then in 5 or 10 years, we will be paradise lost. So I think that they actually believe, whether we agree with them or not, that what they are trying to save paradise. They're trying to usher in a second golden age or a new golden age, however you want to define that. And they believe if we keep on the same path, that not only will we not enter that golden age, but we will, suffer a great fall. And as a result, they believe the way to do that is to impose tariffs as a way to help the United States jumpstart a manufacturing-based economy, or at least bring it back somewhat into line so that it's not so out of whack. Now, if you think about it, for as long as I can remember, one of the biggest knocks on America's prospects is that we run both a budget deficit and a trade deficit. And that is going to, and we've lost our manufacturing base. We don't make anything anymore. We're exposed strategically. We're exposed from a national security perspective as a result. And we just don't make anything anymore. And that's been seen as a negative thing. And part of the reason that nobody has ever tried to fix it is for all the reasons that you see going on right now. First of all, most people can't handle being criticized. And second of all, nobody wants to deal with the fallout of the transition, and nobody wants to deal with the potential fallout of being wrong. Now, we don't know yet in the full scale of things whether Trump will be right or wrong. In the short term, it's extremely volatile. And one of the things we've talked about on this show many times is that if you're going, he is fundamentally changing the way the United States does business. And to fundamentally change the way someone does business, even under the best of circumstances, is going to cause unintended consequences and some volatility. I don't know how many golf fans there are, but Tiger Woods at one point was the greatest player in the world and well on his way to passing Jack Nicklaus as the greatest of all time. But he had some back issues, and as a result of his back issues, he felt he had to change his swing. Now think about this. This is the greatest golfer in the world, and arguably the greatest golfer in history, one of the best swings ever. And rather than keep doing it, he decides to change it. And the reason he decided to change it is because he thought in the long term, it would give him a greater opportunity to become the greatest of all time. So there was a transition period where he was trying to change his swing and it didn't work out very well. But then once he got it grooved in and once he kind of got it figured out, he went back on his winning ways again. Now, I don't know whether it's going to end the same way Tiger Woods' career did or not. But my point is even under the best circumstances, if you change your entire business model, it is going to cause some chaos. At a minimum, it's going to cause volatility. And it will no doubt cause some unintended consequences. So that's where we're at now. But I don't think that Trump is going to pivot, at least not yet. And I know there's a lot of people out there who think that this is all a big surprise to Trump and to Bessent and to his team. Let me tell you, Scott Bessent is not an idiot. Whatever you think of Trump and Bessent and Hegseth and his whole team, these are not stupid people. If you think that if you think that Bessent thought that you could throw on reciprocal tariffs to the whole world and there would not be the stock market come down and that volatility would not spike, you're just not dealing with reality. This is a very smart guy. You might not agree with him, but this is a very smart guy. This is a guy that came up with the idea to break the Bank of England, and he presented it to George Soros and Stanley Druckenmiller, and they put it on and did it. So this is not somebody that's new to this whole global macro scene. Now, think about, what does Trump probably want? Trump probably wants lower interest rates so that they can roll over this debt better. And if you get interest rates down, then you get a weaker dollar. If you get a weaker dollar, it makes your exports more competitive. So what does Trump want? Trump wants lower interest rates. Trump wants a weaker dollar. Trump wants companies making stuff in the United States, and he wants a booming stock market. How do you get a booming stock market? Do you get a booming stock market by having tight monetary policy, or do you get it by having loose monetary policy? Well, typically you get it by having loose monetary policy. So Trump comes into office, interest rates are high, oil is high, stocks are high, interest rates are high, volatility is really low. What does he need to do in order to change that? Well, he needs to get interest rates down to get the dollar down. So that's happening. And he wants short-term, that's longer-term interest rates. He wants short-term interest rates to fall too. Well, how do you get the Fed to go back to easy monetary policy? Well, the Fed responds to chaos. So he's bringing the economy down in the short term because he believes in the long term it will be for the better. It will also probably, or it has the great potential to push the Fed into easier monetary policy than they currently have. While he's doing this, he can still blame it on Biden because it's early enough in the administration, and he can say, it doesn't matter whether he's right or not. He can blame it. He's early enough in, he can blame it on Biden. And then hopefully by midterms, he's got this going the other way. But right now he's also dealing with inflation. So he wants oil down. So look, oil's the lowest point it's been in several years. So he's got that going for him. Copper is down 20% in 2 weeks, right? He's got stock prices are coming down. He's got, the long-term bond has started to come down. So this is a way for him and for Bessent to get what they want early on in the administration. And again, I'm going to say this. I've said this over time. This is not some judo 3D chess move. I mean, they have said all of this. And Bessent has been very clear and said several times that there will probably be short-term volatility in the stock market, but that the stock market is not the same thing as the economy, and that's the Wall Street had its day. Now it's time for mainstream to have its day. The other thing is that it's a relative game. And so, yes, the stock market in the United States has come down a lot in the last 2 months, and especially in the last 2 weeks. But it's still above where it was 15 months ago. So let's kind of keep that in perspective, right? It's still dramatically higher than it was 10 years ago. China's stock market is lower than it was 10 years ago. Hong Kong's stock market is lower than it was 10 years ago. The emerging markets are below where they were 10 years ago. But yet, so it's a relative, and those markets are coming down a lot too. It's not like only the United States market has come down. Those markets have started to come down too. And I think Trump and Bessent and Lutnick and the whole team know this. And I think that they know that they're going to get punched, which they have definitely got punched in the nose. But just because you get punched in the nose doesn't necessarily mean that you lose overall. So while I don't think this is 3D chess, I do think there is a method to the madness. And I think we're just going to have to wait and see, whether or not they are forced to pivot from their position or whether they are able to stay the course longer than most people think. Now, going back to the populist thing, the populism it's one of those things where things can simmer below the surface for a long, long time. But once the lid is removed, it's almost impossible to get it back under control. And I would argue that the pendulum swung so far in one direction that, the top 1% were just making money hand over fist. People who were famous for being famous are making millions of dollars online. And yet the average Joe is out there working 2 jobs just to make ends meet. So while the stock market was high, the overall economy was struggling. And these people put up with it and put up with it and put up with it. But now the genie's out of the bag. And while the pendulum swung extremely far in one direction, it is now swinging the other direction. And unfortunately, I think it's going to keep swinging that direction for a long time. And despite many attempts that will likely be made to try to stop it, I think it's going to swing to the other extreme now. Now, I don't like this. I wish I could snap my fingers and change it, but I can't. But what I can do is prepare for it, and we can prepare for it, and we can talk about the things you have to be ready for. And hopefully all the stuff we have talked about over the last couple months and the last couple years has resonated with you, and you've been prepared for this. And we're going to go over some of the market stuff here in a minute. But many of you know that this year I was equating this year to 2022. And part of the reason I thought that 2025 was going to be very similar to 2022 was that we have a wholesale regime change. In 2022, we had a whole new way of doing business. We were going to raise interest rates rather than keeping them low. And for the first 6 to 9 months, there was a lot of uncertainty, a lot of angst. Nobody knew how far Powell was going to go. Nobody knew how fast Powell was going to do it. Nobody knew what the terminal rate was going to be. People have been on Wall Street for 10 or 15 years, had never seen a rate hiking cycle. It was just a lot of uncertainty. And as a result, the market sold off. But once we got 6 to 9 months into it, we kind of found a bottom. And then we had a booming couple of years. So far, and so I've said at the end of last year and at the beginning of this year, I thought this was a good analog for 2025. And so far, that's exactly what we've seen. And we'll look at some charts here in a second to talk about it. But I think where we're at now is we've had the panic. Things are very, very oversold. But one thing to remember also about 2022 is that by September, markets were down, depending on which market you're talking about. I think the S&P was down 25 and the NASDAQ was down, I think, 50. But along the way, there was 3 or 4 rallies of 10% or more. And so while I do think that we still have more downside to come, I think we're getting very close to one of those swings to the upside because things have very, very much gotten oversold in the short term. Now on Friday, Powell came out because he was giving a speech. And I think there was a lot of people who were hoping that he was going to, say something dovish and come to the rescue of many people's portfolios. But what was the word that he used more than once? Patience. There's another P word. He said, we need to be patient. We're not sure what impact this is going to have on inflation yet and overall markets. It's still too early. So and he said, they weren't going to play politics. There's another P word. And as a result, his rescue didn't come. And so the market sold off even harder into the close. And the other thing that we all have to remember, one of the biggest impacts and one of the reasons that this market downturn has been so severe so quickly is the passive impact on the market structure. There's another P word, the passive impact. Because of the way that the vehicles that invest client money have changed, a large portion of money now is put in passive strategies. I think it's almost 50%. I don't think it's quite 50%. Maybe it's like 45, 46% of assets under management are now passively managed. But in that environment, there's no thinking going on. There's no calling up the management. There's no looking at the dividend. There's no, looking at the balance sheet to see whether, things are in good shape or not. It's just a simple algorithm that says if we have cash, we buy, and if somebody asks for cash, we sell. And that's why markets went up a lot, because every time money got put into people's 401ks or into their brokerage accounts, it just automatically bought stuff and it pushed it higher. The problem is that the opposite is also true. And so once people start selling, that becomes a self-fulfilling prophecy. And that's what we've seen in a big way. And the passive impacts of the indexes having to sell have had a huge impact on the speed with which they have fallen. And the thing is, really nothing has been spared. Equities are down 10 to 15%. Copper's down, I think, 20% in 2 or 3 weeks. Gold fell $100 on Friday. Silver fell $4 or $5 over the last over the last week. Bitcoin's held up pretty well so far. It's around 82 grand, I think. But let's just take, let's do this now. Let's take a look at, let me pull this up and we'll take a look at some markets and we'll go through some stuff and I'll tell you what I'm seeing and I'll tell you kind of where I think we're at and what comes next. Okay, so this is the VIX. I think you guys can see this, and you can see my cursor. Yeah, so this is a VIX chart. It's a daily VIX chart going back to, kind of COVID. So obviously, it was a huge spike during COVID. And since then, we've basically seen trending down and to the right over the last 4 or 5 years. And yeah, there's a couple little spikes along the way, but they almost immediately got under control. Now, last August, we had the huge spike in late July or early August. It got down under control pretty quickly. And then, kind of bounced around. And then we had a mini spike back in March. It got under control really quickly. And then boom, out of nowhere. Well, not really out of nowhere, but, we had the big spike on Thursday and Friday after, Trump's press conference on Wednesday evening. But the point is when we always talk about being prepared, and part of being prepared in your portfolio is always having one eye on the exit and always having some kind of protection. There's another P word, some kind of protection on the downside. Now, not everybody's protection has to be the exact same. Maybe you have some extra cash in your portfolio. Maybe you have some put options. Maybe you have some uncorrelated assets that should go up when risk assets go down. But the point is you want to have that in place before the panic sets in. The last thing you want to be doing is buying protection right now. Because right now, the VIX is at 45. You want to be buying protection when the VIX is down here below 20. Even if you don't think you need it, that is the time to buy it because that is the time that it's cheap. So let's look at the put-call ratio. So, this is the put-call ratio going back 5 years. And, right now we have seen a spike, but it's still not totally extreme. It's not where it was last August, and it's not where it was a few times over the last several years. So I'm not saying that we can't get more downside. We probably will get more downside. But the point is this is not where you want to be buying puts either. You want to be buying puts down here when nobody else is doing it. Puts are starting to get more expensive. So as an example, I'll show you this chart. Hold on, let me find it. Give me a second. I just got to find it here. Okay, so this is a chart, or this is basically just showing prices of puts. Now, if you remember, there was a point at the end of last year or early this year. I don't remember exactly when it was, but you could buy a 6-month at the money put for like 1 to 1.5% of your entire of the cost of the whole to protect the entire portfolio. So you got 6 months of protection for like 1%. It was the cheapest S&P puts had ever been. And we talked then about it was a good time to be buying some of those. Well, right now, to just go out 10 days, not even 2 weeks, to go out 10 days, it costs about 3% to protect your portfolio for 10 days. So rather than paying 1% for 6 months of protection, you're now paying 3% for 10 days of protection. That, my friends, is very expensive protection. That is not when you want to be buying protection. You want to buy protection when it's much cheaper than that. So it's really, really hard. If people are just now looking to put protection onto their portfolio, I hate to tell you, but the bomb has already gone off. So you got to be very, now, not only do you need to be careful with your portfolio, you're probably panicked. And this is not the great time to be buying puts. Now, I'm not saying they won't pay off. Maybe you can buy puts and they'll still pay off, but you're going to be paying a heck of a lot more for them now than you would have if you would have been buying them earlier in the year. So let's go, you know what, let's look at some markets here. So here's the deal. Well, I'm just going to look at 3 different ETFs to look at the overall market. So if you, first thing I'm going to do is I'm going to go back to last July, because if you remember, we actually did a whole podcast on this last July, I think it was in August, where we called it Anatomy of a Trade, where we talked about the decision to both buy a bunch of protection in July and then sell that protection in early August. But the reason we bought protection in July was because, you know, markets were at their high. This is the Dow. The relative strength was in extreme territory, very, very high. And the stochastics were very, very high and starting to roll over. So that was what led us to buy the protection. And then when it came down a lot, you know, you had the RSI crash, you had the stochastics crash, you had the VIX spike. But what happened then is high yield was not cracking and spreads were not widening. So that led us to get out of most of those puts here in early August. And then if you remember, I mentioned again at the beginning of the year and then again in February that we were back at the highs again. RSI was extremely high. Stochastics were really high, and that we were probably due for a pullback. And then a couple of weeks ago, we talked about how the short term, the 50-day moving average had crossed below the 100, and that could then potentially lead to a steep move down. And that's exactly what we've seen. So now, if we look at the RSI is now below 25, which that's getting pretty low. The stochastics are at 40, so they're not super low. But again, you kind of want to be buying puts or protection when everything's at the extreme highs, not when it's down here in this range. But let's look at the S&P. So this is the SPY ETF. So again, you know, back here a month ago, 6 weeks ago, was the high. RSI was not super high, but it was high. Stochastics were pretty high. If we look back last summer, this is when we put protection on here too. We had the high in the market. We had RSI was super high. We had the stochastics were super high. So those are the kind of signals you want to be looking for to put on protection. But now we have the opposite. Now let's just look and see what it's down from the top. The S&P is down 17% from the high, right? The RSI is now below 25 and the stochastics are almost below 30. So, you know, again, where you want to be buying is when things are really low. Actually, if you just look a couple weeks ago, look at this little low spot. You know, the RSI was below 25 and the stochastics were really low. So again, this is not the place to be buying protection. I mean, if you haven't bought any protection now, if you haven't raised cash by now, you probably have to, but now you're a distressed seller. You're not, and you're probably not thinking clearly because you're probably panicked. Now let's look at the NASDAQ. This is the QQQ. So again, going back last summer, we saw the highs. Everything was trending up. RSI was at extremes. Stochastics were at extremes. We got pretty close to that again about a month or so ago. You know, but now we're, again, you know, we how much is it? Let's look and see how much it's fallen. I think it's more like 22% or something, 25%, 22% from the high. And so now its stochastics are below 20 and I'm sorry, its RSI is below 25 and its stochastics are below 25 as well. Let's see, what else do we got here? Oh, let's look at semiconductors because they've really taken it on the chin as well. Again, this was one of this is where we did our big trade back in July. Markets were at its high, RSI was at its high, stochastics were at its high, and then we had the big pull down. We had a similar setup here again in January and February, and now we've had the big drop. But again, stochastics are now below, or RSI is below 20, stochastics are below 25. My guess is that we're probably going to have a little bit more downside this week, maybe a lot of downside this week, but we are very close to a bounce because everything is extremely oversold. I don't have the ability to show it to you right now, but the sentiment data that I look at is as low as it's been in 5 years. I mean, sentiment is just completely and utterly wiped out. And so again, that's not the time that you want to be just buying protection and just getting more conservative. If anything, if you were able to take advantage of this downside, we're probably getting close to a point for a tradable bounce. But I want to be clear. I'm not telling everybody to go out and buy stocks. I'm not saying that this is the all clear, you got nothing to lose, and that we're automatically going higher. What I think is we're going to get sometime in the next 1 day to 10 days is we're going to get a short-term bottom that will then bounce. And maybe it bounces for a couple weeks, and that then gives you an opportunity to put more protection on. But I do think markets will be lower, later this year than they are right now. But let me let's see. Let me see how I can do this. Let me just I'll show you. Let me show you something, and this will hopefully help you understand it a little bit better. So let's go back 5 years. Let's look at 2022 in detail. Sorry, I'm trying to zoom this in so you guys can see it a little bit better. Okay, so here's 2022. Markets started the year at the all-time high at the beginning of 2022. And from the beginning of 2022 until the bottom at literally the last week of September, first week of October, it was a 25% drawdown in the S&P 500. But it didn't happen in a straight line, and it didn't happen at all at once. There was a, there was a 6% rally there. There was a 10% rally there. Another 7% rally. And a 17% rally, right? So even though the market went down 25% over a 9-month period, there was rallies along the way of 6%, 10%, 7%, and 17%. I would expect that that's kind of what this year is going to be like. Now, listen, maybe we'll find a bottom next week and Powell will come out and do QE and everything's up and to the right. I have my doubts, my extreme doubts that that's the case, but you can't rule anything out. But the point is we're probably getting close to one of these rallies just because markets don't move in straight lines and everything is extremely oversold right now. Let's see, what else did I want to show you guys? This is something that I've been following for a long time. And, I think that it's probably, this is just a couple of channels that I've been following, going all the way back to the global financial crisis. And, last in 2022, I thought I don't know if we were doing a podcast. I had said that when we got this drawdown here, that this was probably a short-term bottom, and it was, and we've really rocketed higher. But my guess is that before the year's out, we will go down here and we'll probably tag this green line somewhere. And that would be about a 25%, 26% retracement, which is coincidentally exactly what we got in 2022. That was down 26%. So there's no hard rule that says every drawdown has to be 26%. I just think that that's maybe a decent place to find a bottom. The other thing is I want to show you this. Give me 1 second. Let's go back to this. Let's I'm going to make this 5 years. The other reason why I think we're probably getting close to a bottom is just from a technical perspective, we're not that far away from some support, right? So if we've got 1 touch, 2 touch, this is only about another 2% away, I think, 2 or 3% away. Let's see how much further down is that. Yeah, 2 or 3% away. So, if we have another big down day on Monday or Tuesday this week and we get down into that range, Wouldn't surprise me if that's an opportunity for then kind of a short-term bounce, similar to all the bounces that we had back here in 2022. Whether I'm going to try to play that bounce or not is yet to be determined. We've had a very good year so far. We've been able to protect principal, and we've actually made some money on our puts. Well, we've made a lot of money on the puts, enough to protect all the other risk assets, and then have some profits as well. But let me show you the gold, because gold fell pretty hard on gold and silver. Both fell pretty hard last week, but they're up a lot. But this shows the commercial short position versus gold. You know, they actually covered a little bit last week, and I would expect when they come out next week, this is going to be more up in this range, because, you know, as it comes down, you know, I think you're probably going to see more short covering. Silver is still a little bit more extreme. Silver has come down a lot more, and the commercial shorts only came down a little bit. So we'll have to see what plays out there. Let me show you one more. I'm going to show you one more. I'll show you copper. Copper got absolutely slammed over the last couple of weeks. So, you know, and this is going to help with inflation numbers too. So let's just look over the 5-year period, right? Copper had gone to an all-time high, and then it fell. What did it fall? 15%, 20%? 16%. Yeah. So, you know, copper's actually getting to a point. I want to think about buying that. Let me look at something really quick. You know, because if things continue to escalate geopolitically, et cetera, you know, we could still get some shortages. Oh, sorry. I got to change this. Hold on. Change it to the generic. See, interesting. Hold on. I might have to take a closer look at this. So this is a weekly chart. If we go back to there, yeah, not too far away. Not too far away. We're kind of getting into that. We're kind of getting into that range where if copper falls much more, that might be an opportunity to buy some copper. Let's take a look on a monthly basis here. Sorry, bear with me as I hadn't yet looked at this, so now that I'm looking at it, I'm kind of interested. Yeah, I don't know. Yeah, you know, we get back into that $4 range, something like that on copper. Might not be a bad idea for a little speculative play there. Anyway, I think we're going to leave it at that. Hope you guys have been surviving this okay. Hopefully, all of our talk about having protection and always listen. It's totally fine to be an aggressive investor. It's totally fine to try to get upside when it's available. But you always have to have at least one part of your portfolio that's prepared for this panic. You don't want to be in the middle of all this pandemonium and be freaked out, psyched out, and not have your wits about you. One of the best things about having some kind of downside protection or having some kind of dry powder. Oh, there's another P word. I didn't think about that. One of the greatest benefits of having dry powder, even though it's a drag on your portfolio when things are going up, is it gives you peace of mind. And then when markets freak out and they puke, another P word, when markets puke, you are not freaked out. You're not stressed out. You can think clearly, and you can use that dry powder as an opportunity to take advantage of other people that are distressed sellers. So, okay, I'm going to leave it at that. Thanks for tuning in. We'll be back again next week, and hope you guys all have a profitable one. We'll see you. Bye.